Hello and welcome to another edition of 9 to 5 Live. Last week's US employment numbers were much stronger than expected. We're going to be discussing the implications of that, plus China that stopped buying gold. Francois, hello.
Hello.
Nice to see you. Last week's economic numbers, the employment numbers, they were expected at 180,000, they came out at 270,000. What does this mean now for those who are expecting Fed rate cuts this year?
It means that they need to reassess the scenario very deeply. And by that, I don't mean that they need to say, okay, it's over with interest rate cut, but they need to assess first the time frame. Is it possible that we have something in September? That's the first issue that you need to solve. Bringing 2 rate cuts by the end of the year, or is it maximum 1 rate cut in December? And you mentioned the fact that the number of jobs created was stronger than expected, but what could also worry the Fed is the fact that average hourly earnings were up 0.4%, which is higher than the 0.3 that was expected by the market, which means that there is not only a problem of job creation, but there is still salary wage inflation in the US economy. And that's something that is very, very important. Moreover, you need to remember that by Wednesday, the Fed will come out with its decision about interest rates. They won't change anything. It's obvious that they are not going to cut rate at this meeting. But we will have the dot issue. Will they say that they still expect 2 to 3 rate cuts this year? This is going to be something that people will need to put into the scenario when they reassess the future of interest rates in the US in 2024.
Okay, but this is even more complicated than we thought, because whilst job creation numbers were stronger than expected, much, even greater than the month previously, the unemployment rate has gone up slightly. So it's very, very difficult for us, or the Fed, in fact, to see the wood from the trees. Can you explain that to us, first of all? And then could you maybe the Fed can only look at job wage growth to see whether that's where the pressure is coming from, and then saying to itself that the economy is stronger than expected, and that would reduce their chances of reducing interest rates.
I think that what you need to know is that the unemployment rate and the non-farm payrolls are 2 different sets of statistics. They are not built on the same process. One is related to company, the other one is related to individuals. So that's the reason why you have this divergence of message between the fact that you had a lot of job creation, but then you had an increase in unemployment rate in the US. This discrepancy is here for quite a long period of time. And no economist, nobody can reconcile those 2 developments, because on the one side you have a set of numbers that are telling you that the market is quite strong in terms of labor market. On the other hand, you have something that tells you that it's not as strong as many believe. And that's the difficulty for the Fed or any economist currently, is to bring those 2 things together. One or the other will one day be the right one. Nobody knows which one is giving the right message right now. This is something that is very, very strange and very difficult to understand, but this is connected to the fact that those are 2 processes of getting the statistics which are different. That said, when it comes to wage growth, yes, this is the key issue at the end of the day. But again, you could say that wage growth is terrible, but on the other, because it grew too fast, 4.1%, is too strong. But on the other hand, you have some numbers lately that were revised downward, which are quite satisfactory. Unit labor cost was revised last week, and it was much lower than expected during the first publication of the statistics. So this is also something that is telling you that the inflation picture on the labor side is not as clear as expected. So at the end of the day, you have a Fed which will not be able to say that it has more confidence that the system is moving in the right direction. So the first conclusion you can make, to my point of view, is that first, higher for longer is in place. Second, they will not cut rates in the next meeting this week. Third, they will be very data dependent over the summer, and the earliest you can expect a rate cut by the Fed is in September. And I think that it's a 50-50, and I would incline to consider that they are maybe going to act only in December.
Bearing in mind several central banks have started to cut rates very, very recently, you would have expected to see a move in the currency markets, which didn't really happen between the euro and the dollar, for instance. The euro is down this morning. We'll come to that in a minute, but that's something else. Are you expecting there to be a divergence between US and everyone else in terms of rate cuts? And what will that have implications on the euro dollar, for instance?
A complete divergence, I do not expect. It's not possible. It's not possible because the impact of possible foreign exchange development is something that central bankers need to take into account when they decide the way they set interest rates. So a complete divergence, no, I don't think so. Nevertheless, we need also to remember that the cycles are very different between the region. You know, the US is experiencing a very, very strong economic activity over the last 2 years, connected to the fact that they spend a huge amount of money through public deficit. And in this regard, it's very interesting to notice that the IMF came out over the weekend with a new warning concerning the development on the fiscal front in the US. So the US is very strong. Europe has difficulties to come out from this very, very low growth environment. So there are some reasons to believe that there is room for the ECB to act further in 2024, despite the fact that, to my point of view, for at least the next 2 to 3 months, the Fed is going to remain on the sideline and not going to act on interest rates. But you are right. There is a point where if there is too much of a divergence, it can create a lot of volatility on Forex. It can support the US dollar. And frankly, this is not something that you want to see for the financial market and for the world economy in the current circumstances.
The euro dollar is down. I hesitate to say sharply. It is down quite a bit this morning. Can you explain that to us, please?
The point is connected to the European election and mainly to the aftermath of the election and the result, which is the fact that France has decided to get new parliamentary election by the end of June. It's a choice of Mr. Macron, considering the result that were very, very bad for the French presidential majority. So it's connected to renewed fear concerning the development in Europe, and people are putting their bets on the safe haven. The safe havens are known. They are on the one side the US dollar, and the second one is the Swiss franc.
Let's come to China now. China has stopped buying gold in the open market for the last few months. There was a sudden reaction when the market realized that. The gold market has been butting against 2,400 more or less without ever being able to get past it. Do you think this is the end of the gold bullish cycle?
Okay, first, they stopped in May. In May, they did not increase the position, but over the preceding months, they increased the position. What happened the 3 months before May was that they were reducing the amount of purchase they did in gold. Why? Because the price of gold, remember, the price of gold went up quite significantly since the beginning of the year. So to my point of view, I would not conclude that it's the end of purchase by the Chinese. The Chinese have also reacted to the fact that the price went up quite significantly, so there is no reason for them to really purchase gold at any price. So I think it's more of the fact that they are kind of timing when they purchase, and I don't see that it as a sign that it's the end of the bull market for gold. I think that you will still have some diversification of reserves into gold by central bankers and China in particular. So I wouldn't make too much of the May numbers that was zero in terms of purchase by the Chinese central bank.
What would be your target for gold now?
I think that you can imagine that 2,500, 2,600 by the end of 2025 is something that you could have in mind.
By the end of 2024?
25. Because, yeah, the market is not on a straight line. We are currently at 2,320. We are set a record at 2,450 over the last few weeks. I think that first you need to recoup these numbers. You need to settle and maybe go to 2,600 in a matter of 18 months.
Francois, thank you very much once again. See you next Monday. Bye-bye.
Bye-bye.